All right. I want to thank everybody for coming to my podcast. This is The Mechanics of Money. This is episode 10. First, let's get some formalities out the way. Let's read our disclosure. Before we begin, I want to make something clear. Everything discussed in the podcast represents my personal opinion and a representation of the economic events and financial markets. Nothing in this episode should be considered investment advice, trading advice, or recommendation to buy or sell any financial instruments. Markets are complex systems influenced by countless variables, and every investor has different financial situations and risk tolerance and investment horizon. This podcast is meant for education and macroeconomic discussion and not financial advice. And what we're doing here is examining patterns, signals, and structural risks in financial systems. Because once you understand how the system works, you begin to see things others miss. So I want to welcome everybody to the show again. This is Mechanics of Money, Mechanics of Money, episode 10. I must apologize that I hadn't got an episode out sooner. I've been doing a lot of stuff. Okay, I just got my MBA. Give me a break, right? I just got my MBA in December, so it's taking a little break. But a lot of things have been happening. We've been working on some software. The winds have been pushing my company towards AI, right? I currently work for a company that does AI rubrics. I've been fortunate enough to be able to do that, learn how to do that, to create rubrics, actually train AI. How about that? How sophisticated can we get at that level, right? Also, we're actually developing software. One software that I've developed is a business software, and then the other one is a personal finance software. The one software is called Ordina, and the other software is called Moria. And what we're also excited about is a financial security application, which is called Phalanx 9A, right? Which we're pushing to basically revolutionize the way the financial industry works, right? This is supposed to change the way commerce actually does authentication. So we're very excited about that. So let's talk about the agenda. Let's talk about the different things that we're going to discuss. We're going to talk about Blue Owl. We're going to talk about BlackRock, UBS, credit funds closing, selling off. We're going to talk about how the first bank of 2026 closed, right? We're kind of reading the tea leaves a little bit. We're talking about how Japan's economy is waning, right? There's some clear indicators there. We're going to talk about how 10 tons of gold went missing. Some people have what's the word? Abscond with 10 million tons of gold, right? Where is it, right? And the UK market financial solutions situation where that particular company has collapsed. So I look forward to you listening to my show. Let's start the show. Okay, what we have here is the Fear and Greed report. Now, I always this is one of my favorite reports, is the Fear and Greed report. This report lets you know, talks about the volatility in the market, right? So basically what you have is fear, right? Fear, which is not a good thing. It's not a good thing. It's good if you're sitting on a lot of cash. You have some hedge funds that are sitting on a lot of cash right now, so a lot of people are liquid. So, so it's kind of like a bearish type thing going on. But for the most part, fear in the market is not good. Fear and uncertainty in the stock market is not a good thing. Let's read a quote from Jamie Dimon. You never know where the cockroaches are hiding. This is from Jamie Dimon, the CEO of J.P. Morgan Chase, right? When you start seeing cracks in the wall, right? If you see one roach, you know that it's a pretty good pretty good chance that it wasn't just one roach, right? It's more than one, right? It's more than one. They come in groups, right? So if you see one, you have a bigger problem at hand. Now we have the B Swim report. This is one of my favorite reports. I customized this report for myself to get the information out to everybody on my podcast. Now, I will read a quote from Warren Buffett, right? Again, I use this quote a lot, and this is what spawned the B Swim report, right? That's why I call it the B Swim report. Again, Warren Buffett said, only when the tide goes out do you discover who's been swimming naked, right? So it's only when liquidity dries up. That's what Warren Buffett's referring to, the Oracle of Omaha, right? He's saying it's only when liquidity, when there's a lot of liquidity, a lot of these Ponzi schemes and everything works, right? Everything's working. All the cogs in the chain are churning along, and there's no problems. People can still, rob Peter to pay Paul, right? But when the liquidity starts drying up, then it becomes more difficult. It becomes harder to take out loans, take more loans to pay off another loan that you owe, because the banks are saying that they're no longer making these risky loans anymore, right? So that's what you see. So with the auto loans, you see that the delinquency rates are starting to go up from January to February, right? So it went from 7.3 to 7.6%. And with the mortgages, from January to February, it went from 3.1% to 3.3%, right? And then with commercial property, it's gone up pretty significant as well. Where it's in the red, high risk, where it went from 5.8 to 6.4%. Pretty telling. Okay, so now we're talking about liquidity and the monetary system and indicators. We have the federal emergency liquidity usage. $420 billion was borrowed by banks, right? So we talk about liquidity. We talk about the stress test with the banks. The banks went under not too long ago, and they said the banks were in good position. But one has to ask a poignant question: are the banks really in a good position if they have to borrow $420 billion, right? We also have the reverse repo facility, where we got declining liquidity buffer, and that's also in yellow, that's on the watch list. Then we have the SOFR, repo market stress, that's on the watch list too. The M2 money supply is on the watch list. That's contracting, and the central bank balance sheet is on the watch list too. It's yellow, and the expansion cycles are returning. Okay, next we have the credit mark stress indicators. The high yield credit spreads, rising risk, widening of lows, junk bond usage, hedge fund using the junk bond debt as debt. The hedge funds using junk bonds for liquidity. One example of that is Citadel. Citadel just issued a whole bunch of junk bonds, which is really never been done before, right? A hedge fund has never really issued junk bonds before to raise capital, right? This is the first, and it just definitely shows how desperate some of these hedge funds are right now. Credit default swaps are elevated and volatile, and there's also the watch list, and corporate refinancing risks are increasing due to rates, and that's on the watch list as well. Private credit funds redemptions, record withdrawals pressure. There's a lot of stress. That's yellow. Redemptions is a big issue. We're going to talk about that later in the podcast. Redemptions is a big issue that's going on. We have redemption gates appearing for large funds. So gating meaning that a lot of these hedge funds and banks and credit funds are stopping their clients from taking the money out. And we'll talk about that later. Blue Owl asset sales. They sold 1.4 billion. They've liquidated 1.4 billion in assets, and they're under stress. And BlackRock redemption restrictions. It's all the liquidity control is triggered. So we got that as well. And we'll talk okay, we got the banking system indicators. The first bank failure of the year, Metropolitan Capital Bank Trust. That's in yellow. They failed this year. We're going to talk about that later in the podcast. We're going to give you some more details. Bank lending standards are tightening. Bank capital ratios stable but pressured. And deposit movements, migration to money markets. So a lot of money is migrating to money markets right now. Global macro stress. Japan's debt to GDP is 250%. How about that? U.S. debt to GDP is 120%, and U.S. annual deficit is at 1 trillion plus. Bond market losses hidden via accounting rules. Global derivative market is 845 trillion notional value, and synthetic shares are market and market structure, ongoing disputes, market concentration, mega cap dominance risks, and cap ratio is elevated versus historical norms. Housing affordability is the worst level on record. Gold prices trend a major multi-year rally. Is being served as a safe haven. Silver's volatility, extreme swings. A lot of speculation is going on in silver. And institutional cash levels, the lowest since the 1990s. Retail market optimism elevated is on the watch list. Insider selling is increasing. Hedge fund leverage is elevated. It shows risks, and media narrative is strong bullish sentiment. Early warning system. The professional macro investors monitor a cluster of indicators together. These are some of the indicators that you would look at to kind of read the tea leaves to see the condition of the market, right? We have the high yield credit spreads. Everything is comes from the credit spreads. Once you watch the credit spreads will tell you immediately whether there is trouble in the markets. The repo market stress, that also is an indicator. The credit default swap spreads, the bank lending standards, and redemption pressures, which we're seeing a lot of this. We're seeing some of these signs right now. The core mechanism. A financial crisis often follows a familiar sequence. Liquidity tightens, credit spreads widen, shadow banking systems face redemptions, which we're seeing right now. Asset prices decline, and central bank intervenes. So time for the executive summary. The BSLIM report, its framework suggests this, several liquidity and credit stress indicators are beginning to flash simultaneously. This does not guarantee a crisis, but it does indicate that the financial system is entering into a period where liquidity conditions and leverage levels deserve closer monitoring, and markets can maintain resilient for long periods until they are not. Understanding the signals allow investors and observers to interpret events with greater clarity. Okay, so right now we have a slide. We're talking about the shadow banking system and hedge funds, right? UBS, which is interesting, it was kind of strange. A lot of strange things are coming out of the Epstein files. It's strange that this came out of the Epstein files. But in the Epstein files, it revealed that UBS had $37 billion worth of counterfeit stocks in GME. How about that? That was quite amazing. That was revealed from the Epstein files. Also, UBS is blocking and limiting redemptions. Blue Owl, which is one of the larger players in shadow banking, has started selling off assets, which I mentioned earlier, to the tune of $1.4 billion worth of assets. And they're also blocking and limiting redemptions as well. Also, we have BlackRock, which is also blocking and limiting redemptions. And we also have Blackstone, which is blocking and limiting redemptions as well. Now, we have different stages that are going on right now. It's important to talk about, right? We have different stages. The four primary stages before we have a correction, right? Stage one is money quietly leaves private credit, right? And that's kind of what's going on right now. It's slowly, quietly leaving. But now what we have is that redemptions are starting to rise now, which is stage two. The funds and assets are starting to sell, and you see that's what's going on with Blue Owl, which is a major player, right? Blue Owl just sold 1.4 billion worth of assets, right? And stage three is when funds start blocking withdrawals. So that would be we're actually in stage two, and we're in between stage two and three right now. And then stage four is when you have forced selling and spreads across the system. And that's when the system ultimately collapses. Now, all five large private credit funds in the world are under a lot of stress right now, a lot of liquidity stress. Now, we mentioned earlier that banks borrowed $420 billion from the Fed, right? In addition, we just gave the biggest bailout in history to Freddie and Fannie Mac to the tune of $200 billion. Now, the shadow banking system is failing, and we need to determine whether Blue Owl is the canary in the coal mine. Is Blue Owl really sending a strong message to us that there is something broken in the system right now? So we have to take a strong look at that. Now, what this chart here is, this chart shows a redemption spiral. What redemption spiral is showing that basically people are starting to look for the exits, right? The number of redemptions that are happening are being limited by hedge funds and shadow banks, right? They're stopping people from taking their money because ultimately that's going to put the banks and the shadow banks in very bad liquid situations. They're not going to be able to cover a lot of their debts if there's a run on the bank, and that's what basically we're talking about. But we have to understand what redemptions are, right? I mean, what are redemptions? Basically, to explain what a redemption is, redemptions, it basically means that you want your money back, right? I want my money back, and the banks are refusing. The hedge funds and the hedge funds and the shadow banks are refusing to give people their money back, and that's what's going on. They call it gate pressure spiral. They call it deleveraging cascade, and they also refer to it as a redemption spiral, triggering a liquidity cascade. Okay, but basically, it's kind of like a run on the bank, right? People are starting to read the tea leaves. They're starting to see that there's problems. People can't get access to the money. They see that a lot of these large institutions are starting to list a little bit. They're starting to have some problems with liquidity, and people want their money back, and now they can't get it, which is sending shockwaves throughout the market. Okay, so the first bank closure of 2026 just happened. Metropolitan Capital Bank and Trust, it closed January 30th, 2026. They were actually closed by the Illinois Department of Financial and Professional Regulation, and the FDIC is in receivership. Okay, next we want to talk about the world economy. Basically, the global derivative market is, and we mentioned this earlier, is 845 trillion, right? Which is something that Warren Buffett called the financial weapons of mass destruction, right? He is saying that, hey, having this kind of debt out there is very destructive to the market as a whole, and ultimately will lead to the economic demise of a lot of governments. So what we have with Japan's economy has basically collapsed, right? They had a emergency. The emergency was involved with people buying bonds. When they bought the bonds, and the bonds were initially worth $99. But what happened was the bonds lost their value. They went down to about $30 or $33. I think that's what it was, about 33, right? So people they've lost their money. They lost a significant amount of money in the bonds. So as a result, what happened was Japan had an emergency decision, and the Japan's Institute of Public Accountants, certified accountants, certified that the banks and issuers don't have to recognize the loss. How about that, right? They literally don't have to recognize the fact that the treasury bonds are not worth $30, right? Which they call the policy reserve matching bonds. That's what they call the policy. But basically, this is another way of cooking the books, right? They basically allowing these companies to recognize the fact that the treasury bonds are worth 99, but they're really not worth 99, right? They're worth $33, right? So how about that? They allowing them to recognize the value of $99, but they're not worth $99. So you can imagine the havoc that this is creating on financial statements, where people are getting financial statements where they're showing values of treasuries that are worth 99, but they're not. They're not even worth several percentages of that. So that's a problem. That's a problem. So next we have the UK, the Market Financial Solution, MFS, the major UK leader, has collapsed. The bank is looking at losing 1.3 billion in collateral. This is due to what they call a double pledging, or what they call a rehypothecation. Basically, what that means is when you have rehypothecation, is that you are double selling, right? You are. This is kind of common that's going on in the stock market right now. That's being revealed is that people are taking stocks that they're receiving, and they are selling them again, right? And Elon Musk talked about this as well. He talked about how unique the stock market is in regards to this. It's like you can't sell a house or a car you don't own, but in the stock market apparently you can sell the stock that you don't own. So that's the kind of thing that's going on, and that's what spelled the demise for the Market Financial Solutions, MFC. And then last we have China, where 10 tons of gold went missing in China by the firm Gold Wharf. A lot of the top executives went missing. They went missing, and the CEO is somewhere in Thailand. All right, they really don't even know where he is. He's gone. So they've closed. Gold Wharf has closed down over 1,000 stores, and this has really affected a lot of the elderly, because a lot of the elderly have invested in gold and thought that this store was stable. This firm was stable, and that they could invest their retirement in the company. Okay, now for final thoughts. Again, my name of my company is Diagony Financial LLC. I am the CEO. I do bookkeeping, tax planning. If you like some of the things I do, tax preparation. If you like some of the things I'm talking about, you can visit my website at https ://www.taxman.today. Please like, subscribe, and share. We're gonna talk about final thoughts. The first thing we're gonna talk about is the Donahue George. I've been mentioning this. Is quite interesting. This case where Donahue George has took on bravely, taken on. Here's a man that's been his house has been firebombed. His back fence has been firebombed. His car has been firebombed, and he took up the charge to take on these hedge funds. And what happened is that when he took them to court, this is quite interesting. What happened? We took them to court, and they got close to the discovery phase. And what the hedge funds did was interesting. what they did is they filed a motion to dismiss. And all Donahue George asked the hedge funds is that if in fact you're not creating fake shares, prove it. Produce the blue sheets. That's all he asked. He said, produce the blue sheets. Again, the blue sheets show the minute to second transactions that go on. And that's all they had to do is prove and show the blue sheets to prove that, in fact, that fake shares are not being produced. In the case of some of these meme stocks and some other firms that are being affected by naked shorting. But instead of them doing that, what they did was they petitioned the court to dismiss the case before discovery, and that's what happened. The judge actually dismissed the case without even going to discovery. So Donahue George, in essence, did not even get a chance to prove his case. They just dismissed it, and this really sends a shockwave through the judicial system because it does beg the question: because does that mean that any other firm or company that's being questioned or forced to discover, show in discovery, prove that there's no malfeasance going on, that they don't have to do it? All they have to do is just file a motion to dismiss, and that's it. Because in essence, they never did prove it. They just filed a motion to dismiss. So next what we have is we'll talk about the national debt. Okay, so what we have with the national debt is increasing $1 trillion every 90 to 100 days. That is $10 billion per day. That's 400 to 450 million an hour. That's $120 million per second. And this pace has accelerated sharply since 2023. Okay, so historians compare this period of time to it would go up $1 trillion every 1 or 2 years in the 2000. In 2010 to 19, every 8 to 12 months, and in 2020 it was every 1 or 2 months, and now in 2024 and 2026 is every 3 months. Okay. So next, I want to talk about this book by Chris Hedges. The interesting book, and the name of the book is America: A Farewell Tour. Right. So right here, you'll see a quote I put here, and in the quote it says that the United States moved from being a nation of production to a nation of consumption. What he means by that is that anybody that studies this country and over a long period of time, they'll notice that between the 1970s and 1990s, there was a paradigm shift. America stopped making things, right? And you'll hear people say this in passing, right? We don't make stuff anymore, right? We depend on other countries to make stuff for us, right? And at that point, that affected us, right? That's why our deficit right now is, so high. Our deficit is so high versus our GDP because we really don't make anything. What do we make? So that's what Chris Hedges talks about. He talks about this, and I've mentioned this before. This is ultimately how empires decline. How empires end. The United States has transitioned from the production to consumption. The manufacturing industrial production has been replaced by financialization and consumer debt. The loss of utilized industrial jobs and weakened economic stability and working class. So basically what you have here is the devaluation of the dollar, right? How are we going to get out of this inflation? Basically, with Japan and the United States, what they're going to do is they're going to spin their way out of it. But what happens is when you try to spin your way out of it, you create inflation. And inflation ultimately devalues the dollar. And that's what you see what's happening now. The dollar is being replaced by the brick, the brick in the UK, right? Is being replaced. And we don't know if that's going to stay that way. We we don't know if it's. I know some of the African nations are putting together, and they're trying to put some currency together as well. The U.S. dollar is definitely being devalued. Um, and what they call that is financial repression, right? That is a way for that is a skillful way for the government to try to handle debt by 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 spending more and devaluing the debt. That's how they try to handle the debt that they have, and that's called financial repression. Okay, well that's all I have to say, and you have a nice day, and I appreciate everybody talking to me, and thanks for all the support, and you have a nice day.